What's up, everyone, and welcome back to the channel. I'm your Panda Investor, broadcasting live from my cozy bamboo office. Today, we're diving into a topic that has the entire financial world buzzing, and frankly, it even made my panda ears twitch. We're talking about the Oracle of Omaha, Warren Buffett, and the mountain of cash he's sitting on right now. As of the latest reports, Berkshire Hathaway, Buffett's legendary company, is holding over $189 billion in cash and short-term treasuries. Let me say that again, 189 asterisk billion asterisk dollars. That's not just pocket change, it's a colossal war chest. And when a legendary investor like Buffett decides to stockpile cash instead of deploying it into the stock market, it's not just a casual decision, it's a signal, a big, flashing, bamboo-sized warning sign that every single one of us should be paying close attention to. So, the billion-dollar question is, why? Why is Buffett hoarding cash when there are thousands of companies to invest in? Is he scared? Has he lost his touch? Absolutely not. To understand what's happening, you need to understand Buffett's core philosophy. He isn't panicking. He's being patient. He's waiting. Think of it like this. I love bamboo shoots, but I'm not going to pay a premium price for them when I know the best, juiciest shoots are available after a good rain. Buffett operates the same way. He's waiting for the perfect deal, for a company he loves to go on sale at a price that is too good to refuse. He's waiting for what he calls a fat pitch. This isn't the first time we've seen this behavior from him. Looking back at history, Buffett's cash pile has often swelled right before major market downturns. Before the dot-com bubble burst in the early 2000s, he was criticized for not participating in the tech frenzy, holding on to cash instead. When the market crashed, he was there, ready to scoop up incredible businesses at bargain prices. The same thing happened leading up to the 2008 financial crisis. While others were leveraged to the hilt, Buffett had liquidity. This allowed him to make legendary deals with companies like Goldman Sachs and Bank of America, deals that generated billions for Berkshire shareholders. His strategy is simple yet profound. Be fearful when others are greedy, and greedy when others are fearful. Right now, the market is arguably showing signs of greed and over. The S&P 500 has been hitting record highs, and certain sectors, especially in tech and have seen valuations skyrocket. Buffett looks at this landscape and doesn't see many opportunities that meet his strict criteria for value and long-term potential at a reasonable price. So, instead of chasing the hype, he waits. He's like a patient predator in the financial jungle, conserving his energy for when the perfect opportunity presents itself. So, what does this mean for us, the everyday investors, the pantas in the bamboo forests of personal finance? It absolutely does not mean you should sell all your stocks and run for the hills. Panicking is never a winning strategy. Instead, we should learn from the master. When the smartest money in the room gets quiet and starts saving, we should prepare, not panic. The first lesson is the power of having cash on hand. In the investment world, cash isn't trash. It's a strategic asset. It's your ticket to opportunity. Having a dry powder. Fund cash set aside specifically for investing means that when the next market correction or crash inevitably happens, you won't be a victim. You'll be a savvy shopper with a wallet full of cash, ready to buy great assets at a discount. That dip, that crash, that's the buffet that Buffett is waiting for. And you should be ready to join him at the table. How much cash should you keep? It depends on your personal risk tolerance and financial situation. But having a portion of your portfolio liquid is always a prudent move, especially when valuations are high. This isn't about timing the market perfectly, which is impossible, but about being prepared for volatility, which is inevitable. The second lesson is cultivating patience and discipline. It is so tempting to feel a mote of fear of missing out when you see certain stocks going to the moon. But chasing hot trends is often a recipe for disaster. Buffett has famously said, "The stock market is a device for transferring money from the impatient to the patient." Your greatest advantage as a long-term investor is your temperament. Stay calm, stick to your strategy, and don't let the daily noise of the market distract you from your long-term goals. Remember, opportunity doesn't always knock politely. Sometimes it crashes through the door. Those moments of market panic are when fortunes are made. By studying Buffett's current stance, we're getting a masterclass in prudence and strategic waiting. He's not predicting a crash tomorrow, but he is preparing for the possibility that better prices will be available in the future. So, let's recap the Panda truth for today. 1. Observe what the smart money is doing. Buffett's massive cash pile is a signal to be cautious and prepared to keep some cash ready. Your dry powder is your best friend during a downturn. It transforms fear into opportunity. 3. Stay calm and disciplined. Don't chase hype. Focus on your long-term plan and wait for your own fat pitch. Patience will always grow stronger than panic in the long run. By adopting this mindset, you're not just investing your money, you're investing in your own financial wisdom. You're learning to think like one of the greats. This is your Panda Investor, reminding you to stay smart, stay patient, and thanks so much for watching today. If you got some value from this video, please hit that like button. And if you haven't already, consider subscribing for more insights into the world of investing. Let me know your thoughts in the comments below. Are you building up your cash reserves? See you in the next video.